Hello everyone, welcome to Derivatives Insights. In previous videos, we have discussed derivatives and types of derivatives. Today we will discuss futures with an example. Let's get started. So here today I am taking example of Nifty 50 index as an underlying asset. So for the corresponding Nifty 50 futures, we will take an example and discuss how the payoff graphs will look like. Assume the spot price of a Nifty 50 index currently at 20,000. So an ex person believes that there is a positive momentum in the market. So the value of Nifty 50 might rise to 20,500 by end of this current month. So he has a positive mindset like the price of the index will increase in this month. So he goes and buys the Nifty corresponding Nifty 50 futures of the current month at 20,070 rupees. So if you look at that for the spot price 20,000 and for the future price it is 20,070 rupees. The spot price is nothing but the underlying asset value. So for Nifty 50 futures, the spot price is Nifty 50 index value. So if you see the difference of 70 rupees, it is like a, since it is higher than the spot price, so we call it as a premium. So Nifty futures are trading at a premium of 70 rupees from the spot price. So this difference will always be there. It is not like for this month or next month. Anytime there is always be difference between the spot price and the futures, but it may be positive or negative. In this scenario, it is plus 70 rupees, but there are certain scenarios where this value might be lesser than the spot price. What how this value will evaluate is a complex formula. So for now, we will understand that the spot price and future prices are not always be the same. So this difference has multiple factors can uh, affect the value, the difference value. So something like a cost of carrying the futures contract or interest rates or the market conditions. So there are multiple factors which will make effect for this premium or discount values. So okay, the ex person bought Nifty futures at 20,700 and at the time of expiry of that contract on the expiry date. So the index value, the spot price of Nifty 50 closed at 20,200. So the expiry date here is like for every month contracts we'll be having an expiry date. So in for Nifty 50, the expiry date of a monthly futures contract will always be the last Thursday of that month. So let's take if you take July, currently this video is recording on July. So on July 2024, the expiry date will be on 25th July 2024. That is the last Thursday of that month. In case if the Thursday is an holiday or a trading holiday, then it will be moved one day forward to Wednesday, like 24th July will be the expiry day. So at the time of expiry, the spot price has make a move of 200 rupees. And one more point to note here is like at the end of expiry, on the day of expiry, both the spot prices and future prices will converge and they will settle at a same price. So that means if Nifty 50 spot price was traded at 20,200 or it settled at 20,200, the future prices also will get settled at the same price. So how the difference becomes zero is like and every day passed by this value, the difference value at the time of entry, we have 70 rupees difference, right? This value will decrease for every day passed by. Like after 2 days, it will decrease to 60. Then it will goes to 50, 40 like that. At the end of the expiry, this value will get converged and the difference between the spot and future will be zero. So as we mentioned, like there is a move of 200 points in the spot price and the future also made a move and both closes at 20,200 rupees. Now let's consider how much that X person make a profit. Since he bought Nifty futures at 20,070 rupees and sold at 20,200, he made a profit of 130. Even though the market has make a move of 200 rupees, but the person makes a profit of 130. That is because of the premium value. What if market closes at 20,070 rupees itself? That means the person does not make any profit or loss here. So this point we call it as like a break-even point for any trade. For the trade which the X person has taken with a premium of 70 rupees, that 70 plus the spot price when you add it, that will be the break-even point for that person for the trade where the trader will not make any money. Now consider if market hasn't moved anything. Let's say it started at 20,000 and went 100, 200 points up, then it came back and closes at the same point where at the time of beginning of the trade, like 20,000. Since Nifty futures also closes at 20,000, so the X person makes 70 rupees of loss here. And if it trade really went wrong, instead of going rising, the let's say this index price went down and it traded like a 200 points down, then Nifty closes as 19,800. Then the person makes a loss of 200 from the spot price plus 70 of the premium, total 270 rupees. He has to book the loss here. So it is very linear graph. Like if index rises, the underlying asset rises, it has to rise above the premium value when we are buying the futures. Then the trade will be a profitable trade. If it is below that, if it is below the break-even point, then it will be a negative trade where the trader has to book the losses. Uh, let's look at the payoff graph in summarizing those different scenarios, how the profitability will impact. So here, I have taken the Nifty futures. Currently Nifty futures of July month contract of 2024 is trading at 24,347 rupees and the spot price is around 24,300. So there is a difference of this 47, 48 rupees, right? If you see, if you add that different value, difference value between the spot and futures to the spot price, then your break even will come. That is 24,348 rupees. So for you to make this a profitable trade, the spot price has to make a move of more than 48 rupees. So that's what here, if you see this underlying price, 24,300, the break-even point is here, which is 24,348. If it goes beyond this, we will make a profit. If it goes below this, then we will be making a loss. And if you see the probability of profit is always approximately close to the 50% for Nifty futures. It is just below that 50% is because of this premium value what we uh, provide, which we have to overcome our spot price. So because of that, it is just slightly before the 50% of probability. And the maximum profit, maximum loss is always undefined because how much the market moves, you will make that much of profit. Of course, on the downside, the maximum loss will be the buy price, 24,302 is the maximum that can be go down. And here, if you see the estimated margin of 68,000, so we will discuss in detail in the next video how what is this margin value or the premium, what it says here. So you may get that out like one quantity here it says 24,000, but why we have to maintain a margin of 68,000. So this detailedly we will discuss in the next video, and also we'll discuss more about the expiry dates, the lot sizes, which actually make this difference, and then this estimated margin for trading in Nifty futures. If you like this content, please share it with your friends this video and hit the like button and subscribe to our channel for the future. videos. Thank you.